Good morning, good afternoon, and good evening to everybody. Thank you for joining us on the Base Carbon Investor Call. Before we begin, I'm just going to put up a forward-looking statement and give everyone a moment to review it. Perfect. Thank you everyone for joining the call. On today's call, we have Michael Costa, the CEO of Base Carbon, and the CEO of Investor Cubed, Neil Simon. Without further ado, I'd like to hand it over to Neil Simon.
Right. Thank you very much, Jan. And good morning. Well, I guess good afternoon, good evening, depending on where you are to everybody today. Very, very excited to have Mr. Michael Costa, CEO of Base Carbon, on the call with us today to update everybody on a couple different things. Before I say that, just a note, Investor Cube, staff, representatives, we're all shareholders. We're a big believer in the company. We've been buying the stock actually in and around these levels. Actually, I bought it higher. I think my average is 50, 51. But in any case, we are shareholders. We're very excited about the company. I've been working with Michael since about January of the new year. I've seen this company basically provide updates on what they're going to do. And actions speak louder than words. And what I've seen Michael Costa do is execute. Had a significant oversubscribed offering, raised a chunk of money. I'll let Michael get into it. Executed on their business plan. Cash is now starting to roll in. On a note, we are a bit flabbergasted at Investor Cube that we are trading at this level with the company's outlook, current cash position, and where this company is going. And I believe that Michael will provide some insight and an update on what's happening. And then without further ado, Michael, I'll hand it over to you to update us on what's happening. And then we'll follow this by a question-answer period, which will kind of be two-phased. One is over the last many weeks, we've received a bunch of questions, so we'll address those questions after Michael finishes his update. And then two, during the webinar, we typically also get some questions. Just so you'll know, because of time constraints, if we can't get through all the questions, not to worry, we will forward them to Michael. Michael will answer them, and then we will email them to you. And again, on that note, Michael, thank you again for taking the time to talk to all of us today, Michael. We're really excited about Base Carbon. I'm going to hand it over to you to update us and tell us what's happening.
Michael, you're on mute.
You guys had muted me prior. Sorry about that, everybody. I was let's start over. I was thanking everybody for being here. And genuinely, time is always scarce. And as the folks on the call know, I spent my first 20 years of my career on the buy side, so I know how scarce time is. So really grateful for everybody taking the time out of their day to spend time with us today. And the second thing I'd say is, Neil, I don't know if I've ever heard the word flabbergasted on a investor call. So there's not that many firsts when you've done this long, but that is a first, and gold stars for polysyllabic words this early in the morning. So thank you for that. As Jan said, there are, I think we're going to put the safe harbor forward-looking statement slide up just so everybody can take a look at that, and my lawyer doesn't yell at me, and then we'll jump into it. So these calls are always a little bit difficult in that there's a whole range of investors, shareholders, potential investors, and people who have never even heard about the company, or they're saying, "Hey, what's a carbon?" So why don't I spend, and I want to be respectful to our shareholders and people who do know the situation really, really well, that we're not chewing a bunch of time unnecessarily. So maybe I'll spend 5 or 10 minutes and just give a really high level overview of who we are and what we've built, and then we can get into questions. And I think a lot of for the folks that are a bit newer here, a lot of the meat for the bone will come out in those questions. And as Neil said, we're happy to spend a lot of time afterwards getting folks up the curve. So really simply, Base Carbon is a upstream producer of carbon. We have generate voluntary carbon credits as well as I would call near compliance credits. And you can think about us as the intersection of both a producer and an upstream commodity producer, as well as a financier. And in that, the way we've allocated capital and the way we've approached generating risky streams of carbon and therefore risky streams of cash flow has been really through a structured approach to the marketplace. And I think that that's a really important backdrop given the transitional nature of carbon markets in general and the nascence of the market. As Neil mentioned, we're a public company. We trade on the NEO exchange, which is now the CBOE under BCBN, and on the OTCQX in the US. To frame the opportunity and frame the business, we have roughly about 115 million shares outstanding, and we raised 50 million Canadian dollars in our large raise that we did in basically the Q4 of 2021, co-led, co-underwritten by BMO and Bank of Montreal, and BMO and Raymond James, BMO being Bank of Montreal. In any event, that capital, pick your FX rate, call that 37 million US dollars. We allocated that capital into three key projects within carbon markets. Two household device projects, which are devices that are distributed to low income or no income families in LDCs to mitigate the amount of smoke that's generated in their abode from either cooking, from heating water so that it's potable, or from heating their home. In doing that, it reduces the amount of woody biomass that's burned, therefore abating the amount of carbon in the atmosphere, which is really, really good. These methodologies have been out there for 20 years. We can talk about that. We've allocated about 20 million. Today I'll talk round numbers. All of the gritty disclosure around 9 decimal places worth of precision is in all of our public disclosures, including our AAF. I'd encourage people to go read those. But in any event, we've allocated about 20 million US dollars into our capital project in Vietnam with our project partner CIBCO, and about 9 million US dollars into our project in Rwanda with our project partners Del Agua. Both of those projects were delivered on time and on budget, something that is a lot of companies try to do in junior Canadian resources, and very, very, very few, if any, end up doing. Both of those projects now are also producing. So within Vietnam, we have a fixed price offtake with Citibank, the Citibank, whereby we've produced about 30 million US dollars worth of revenue to date in that project, and we're expecting about 6 million more prior to the end of the year in that project. Again, in context of a project that we invested $20 million into, and we have a significant phase 2, as we call it in that project, where we enjoy a $5 call option on all of the volumes of the project. We do get called away on a portion of those volumes, but we get called away in a double-digit price. So it's a low double-digit price, but a double-digit price notwithstanding. So it's a very, very attractive phase 2 that we've generated a cheap/free option on. We also enjoy an expansion rate within that project, which I'm sure we'll get into today. In Rwanda, our project partners Del Agua, who are wonderful to work with, and CIBCO for that matter, all of our project partners are really, really good people and really good operators. Our project partners in Rwanda, Del Agua, have delivered that project on time and on budget. We have first issuance of credits in that project as of this year. We are in our Vera account, Vera being the registry for the carbon credits. We are sitting on 700,000 correspondingly adjusted credits. We'll talk about again what a corresponding adjustment is here today. For those that are new, for those that are not, they know exactly what that is, and they understand the value, and especially the value of the corresponding adjustment, as it is the mechanism that will allow credits to really be eligible for CORSIA inclusion, and therefore enjoy CORSIA pricing as the market continues to evolve. And a corresponding adjustment, frankly, is just valuable in and of itself because it mitigates double counting. In any event, we're sitting on 700,000 credits there. We expect by the end of 2024, we'll have, and possibly in the beginning of the first quarter of 2025, but really within the next 6 months from where we sit here, we'll have gotten through our phase 1 of that project, which represents just under 2 million credits that will be sitting in our Vera account to the benefit of Base Carbonate shareholders. We do have a revenue split with our partners at Del Agua. We've given some indicative pricing in our AIF at an indicative price of what the net back to Base would be. But I think the key takeaway there is that at anything approaching what market prices are, Base enjoys the vast majority of those economics. We also enjoy a phase two there, where we enjoy lower percentage economics, but on significantly more tonnage than where we sit right now on an additional about 5.3 million credits gross on that. So to us, again, very, very valuable project. And we're looking at ways that we can expand our relationship with our partners in Rwanda and Del Agua. Finally, our most recent project is our first capital allocation into carbon removals as opposed to carbon abatements. So when you think about removals, you can bifurcate the world into technology for just nature-based. Nature-based is really simple. When carbon-based life forms grow, they sequester carbon because they're made out of carbon. So when a tree grows, that trunk is sequestering carbon. As long as the tree is permanently planted and that forest sits there, that is permanent carbon removal. So we're investing with our project partners VNV and CEO Sandeep, we think very, very highly of in India, to plant 6.5 million trees on smallholder lands in the northern province of India. We signed that deal almost a year ago to the day, and as of the time of this call, we've planted in excess of 80% of our trees. We also enjoy a expansion option in that project as well, which we think is highly, highly attractive. So when you think about the enterprise from a high level, and Neil, I'll harken back to Neil's word of flabbergasted. I don't know if the company is flabbergasted, but we're certainly I wouldn't even say we're confused. We find opportunity and we express the best risk reward for our shareholders and investors where we can. And as we sit here trading in the high 40 cents Canadian dollars, as I said, on just south of 115 million shares outstanding, with a business that, as of quarter end, plus the subsequent events that we've issued, is sitting on just under 19 million US dollars worth of cash. So call it, around 26 million Canadian dollars at today's market. We're sitting here with, of our current market cap, about half of it in cash. And that's without the further capital that we're expecting in the second half of the year, the further issuance in Rwanda, and that doesn't value the 700,000 credits in our Vera account, correspondingly adjusted in our Rwanda project. So a lot of companies say this, but a lot of companies really don't understand how to value businesses. We strongly view our business as incredibly undervalued, and we have the background and the experience, both as individuals and as a team, to actually have real credence and real firepower behind that view. With that, because we've generated revenue, because we've generated free cash flow, again, a little bit of a odd duck relative to junior capital markets, whereby situations are largely reliant upon the equity markets to finance them, or else they're game over, they're out of business. Said differently, notwithstanding that there's value there, they're liabilities until they become assets because of their need of financing. We don't need financing, and quite oppositely, where we've utilized our normal course issuer bid. We've purchased, I believe it's right over 13 million shares to date, and we continue to judiciously use our normal course issuer bid, where our ACB, our average cost basis of our purchases, are right in and around today's market. I think a little bit higher, call it right around 50 cents, give or take, but it's been highly accretive. And to us, while we're frustrated with the market, we're happy to use the NCIB here, and we're happy to build our business, because the thing that's most important in junior market situations, and frankly any market situation, is the business itself. And our business is not only sound, but it's growing, and there's an incredible amount of opportunity. And because we've turned the flywheel not once but multiple times relative to the success we've had, the free cash flow we've generated, we feel that the proof's in the pudding, both in the business itself, the team, the management, of our ability to navigate carbon markets as they continue to evolve, and to continue to build this business forward. So with that, there's a lot that I missed. There's a lot of nuance. There's a lot. But with that, why don't I pass it over to Neil, and we can start getting into the questions and talk about where there's opportunity, and where we see this business going.
Right. Thank you very much, Michael. That was great. And I guess that'll be my new word of the day, Michael, flabbergasted. So I'm trying
Exactly.
to incorporate that into other phone calls today as I speak to shareholders.
You
Jan,
can be flat. You guys can be flabbergasted capital. I like it. You
we'll
find situations you're
consider a name.
flabbergasted.
Well, I'll tell you right now, with base trading where it is, I am. I mean, I probably should change it because it's overwhelming with just the sheer cash component alone. Really, I don't know how it is. I think we're all confused, but in the end, everything will trade based on fundamentals and growth, and so we know it'll happen. And in my eyes, it's just a matter of time. And right now, I do believe though it's obviously represents an ideal and an excellent buying opportunity at this level because it is pretty cheap and less than half of the issue price. So on that note, though, we are here to talk about questions. I'm going to hand it over to Jan and mute myself. And Jan has a list of questions, as I did mention before, though. If we can't get to them all, we will ensure every question is answered. If anybody on the webinar right now does have any questions, and by all means, you can email them to info@investor3.ca. And again, we'll try and get to as many as we can. And again, thank you very much, Michael, for the update. I'm going to mute myself. And Jan, I'm going to hand it over to you to start going through the questions.
Thank you, Neil. Thank you, Michael, for the presentation. The first question. Given the ongoing volatility and uncertainties in the carbon market, how does Base Carbon ensure it remains competitive and capable of capturing long-term value?
Yeah, well, first of all, again, I will harken back to experience. I've been involved in so many markets that are volatile, that there's uncertainty. If this market had zero volatility and had high levels of certainty, the implicit expected returns that could be generated would be really, really low. Like let's just start with that as a starting point. So you look at well, won't get into other examples of other markets. We don't have the time or the energy to do that today, but I think that that's part and parcel of where the opportunity is. Secondly, when from afar, I depersonalize it and I look at base, as I said in the intro, we've done this. The carbon market has been volatile. There has been uncertainty in the 2.5, 3 years that we've run this business. The 2.5 that we've been public, and the 3 years going back to the 6-month private stub period as we were building the initial part of the infrastructure of this business privately. We've successfully navigated these waters. And that's not a humble brag and saying, hey, look at us, look at how great we are. But we really try to go back to just really basic underwriting, very basic business practices, very basic margin of safety based work in what we do. We think a lot about where we have edge. We think a lot about what we know and what we don't know. We think a lot about what potential unknowable unknowns are out there that could hurt us. And then we think about what is the margin of safety of how we're expressing this risk within our business, within our book for our shareholders. And when we think about that, it's all in the context of our equity cost of capital, which I'm sure there'll be questions on this, but that's why we again, I'll use the word judiciously, but are judiciously using our normal course issuer bid. The second thing I'd say is that information in a market that is evolving is paramount. And I think we really, really punch above our weight from an information standpoint. First is we've got, I think, a team that is well experienced and well in excess of experience of virtually any junior market company that I know of. And again, that's not a hey, look at us brag, but I think it is a key component attribute of this company. And again, I say that from a place of experience of spending 20 years on the buy side and spending my 10,000 meetings on the other side of the table across a whole host of different types of junior market businesses. We understand risk, we understand our market, we understand carbon, we understand capital. But that's only so valuable as the information streams that you have. Because of where we punch above our weight in terms of experience, we bring a whole host of relationship internally. And then wrapped around that is our relationship with Abex, which we spun this business out of. And so our relationship with Smarter Markets, I'm sure folks here, if you don't know about Smarter Markets, go to whatever I'm not very techie, but go to your podcast platform. It's super duper cool. It's super duper fun. It's a great way to spend a weekend morning with when you're walking or you're getting your coffee or whatever you do. And that's not a plug. It's actually just really, really cool. And there's a big focus on carbon on there. There's a big extension of relationship to us base that way for our sponsorship and our involvement in Smarter Markets. Secondly, it's the relationships of Abex. Abex, as they commercialize their commodity exchange, they now have a carbon benchmark. They're now that price discovery within the market, and there's the proper walls. We're a potential customer of Abex just as much as anybody else. But as that market evolves and those information flows, that's really really valuable for us. It's in a market that is opaque, and opacity at a level is a version of uncertainty, and uncertainty is risk. So for us, it's these disparate types of information flows and relationships we have in the market being tempered by the team and the skill and the experience that allows us to allocate capital and reallocate free cash flow appropriately. And again, I'd say to the investors that are new here, you don't have to trust me for it. You can literally look at what we've done, how we've allocated capital, how we've structured our business and our deals to understand what we would do going forward. So it may not be the same flavors, but it's always a sequel to the movie. And the rigor and the practice by which we brought to it, that part of it doesn't change.
Perfect. Thank you, Michael. Some have forecasted the complete implosion of the CORSIA market and the shunning of the VCM by corporates. Can you share your thoughts on this?
Yeah, like for people can forecast things. That's great. The first thing I think about as 100,000 foot when somebody forecasts something, everybody's got skin in the game somewhere, and everybody talks their book, and everybody has an incentive scheme. So I always, before so and so says XYZ, man, I really think about what their incentive or what they're really trying to say behind what they're saying. So that's the first sort of really really high level, I'd say. The second one is I think that there's always been a misperception around what the voluntary carbon markets were and were supposed to be and or what are going to become. And I think some of that misperception was born out of the really frothy go-go days of 2000, 2001, when you start to see, and I won't name names, but large investment banks or large consulting firms putting out really splashy numbers around what the growth of the VCM could be with these really hockey stick diagrams of like acorns grow to the moon. And that's all well and good, but that's not actually in our professional experience or anybody's how markets grow. First of all, markets grow sort of choppy. And especially with something like the VCM, that's always intended to be, or carbon markets in general are intended to change behaviors of underlying. If we were sitting there only offsetting the activities of humanity as we decarbonize as a species, and we're doing this in 100 years, guess what? We failed. So it's not intended to be an end all be all. The VCM is, and I've said this in other forms, but to me, it's sort of like the on ramp or the waiting room into whatever the ultimate market-based solution for carbon and for environmental commodities are. And I think that a lot of those are and will be, and we've always thought this, be derivatives of governments, sovereigns, and industry having their own offsetting schemes, i.e., compliance markets. And that's a really, really good thing for a couple of reasons. There's financeability there. You've taken down the uncertainty. There is a level of sort of like structural seniority between those that say, hey, here's how we're going to decarbonize, and those that are doing. It's not necessarily bilateral. So for us, the VC, and you can see it how we've expressed our book. We've got and we got very lucky on this, and our project partners in Del Agua have spent an incredible amount of time. The government of Rwanda, it has been wonderful for the Del Agua guys to work with. But having the first correspondingly adjusted credit on the fair exchange in our project in Del Agua is a great thing. But we also spent a lot of time and energy at base thinking about how, as we were allocating capital, how and where markets transition, where is there, long duration legs? And if there wasn't long duration legs, how do we structure things for the period of time that we have confidence to allocate, to express that view, and then to be able to turn the capital within our book thoughtfully and efficiently. So, the whole carbon market's going away. I don't know. You can say that about every market. There's always, chicken little, comments out there. And there's always the people that say acorns are going to grow to the moon and carbon's going to be priced at like $1 billion a ton in 6 months' time. My professional experience is that, the world generally hugs the middle of the extremes are never really the investment case. The investment case is in the middle. And I think if you express that and have real knowability around that and mitigate the things that you don't have knowability around, you make good money, and you make, especially in a market like this, as we talked about before, that has a lot of uncertainty or perceived uncertainty, you can make wonderful expected returns.
Thank you, Michael. Excellent answer. This next question is a two-part question. The Rwanda Cookstove project receiving Article 6 authorized label, how do you anticipate this will affect the valuation and attractiveness of these credits, a ballpark measure of the value of the credits? The second part is, are you planning similar certifications for other projects?
Well, the first thing I'll say is I just had a flashback to standardized testing when we were all in high school of like, it's a two-part question. Will I be able to remember both parts? So hopefully I can remember both parts, but you may have to refresh me. On the first part, in terms of getting the corresponding adjustment in our project in Rwanda, it does have impact on pricing. Number one, it just has general impact in the market. There's a number of different pricing services. Viridius is one that we use, that we like. So you can just go look for various regions of what a corresponding adjusted, a non-corresponding adjusted credit trades at, and then potentially what corresponding adjustment credits trade at. Within our projects as they sit right now, the real value, especially on the Vera exchange, we really like working with the Vera guys. They run a really good exchange. And by exchange, I really mean registry. Sorry, brain's going a little bit slower than my mouth today. Apologize. But the real value of the corresponding adjustment is a look through to Corsia, which is the airline offsetting scheme. There's a lot of nuance. I guarantee you there's going to be questions in your list. If there's not, tell me after this one and we can pause and spend some more time on Corsia. But you can look into the marketplace of where Corsia pricing is. Corsia pricing right now, and I'll use the ABEX exchange because there is a pause being put on the ICE the Corsia contract for various reasons. The ABEX benchmarks are active in trading, so I'll just use those. Those are the best and most recent data. But the ABEX, as of when I checked with the gentleman over there, Alistair, who runs that part of the business, is doing a great job over there. The December 24 contract for Corsia is at 25 and 3/4. The December 25 contract is at 15 and 1/4. That is well in excess of the prices we're seeing for non-Corsia / non-CA. Again, the CA being a necessary component, which mitigates double counting for inclusion in a Corsia. Now, I'll spend 30 seconds on Corsia now because it's really, really important. Corsia, a Vera inclusion in a Corsia hasn't happened yet. Gold standard inclusion in a Corsia hasn't happened yet. Why hasn't that happened? Because those exchanges basically needed to make some tweaks to how they did certain things within their registries to be able to amend themselves to the rules of Corsia, which is administered by the ICAO, the International Civil Aviation Organization, which is basically like a specialized body underneath the UN. When you really delve into carbon, when it all comes back, the UN is still, you think about hub and spoke, the UN is at the central hub of a lot of the carbon policy in terms of it pushing it out, administering it, overseeing it, not necessarily as it of itself, but through organizations that it works with or has some kind of influence / control over. That's a good thing. That's actually a really, really, really good thing. So in any event, the ICAO will spend time this fall, and the advisory body for the ICAO, more specifically, will spend time this fall and, possibly, and we think hopefully, include gold standard and Vera. The reality of the market, and again, as I've said before, and I'll keep saying on this call, we as a group believe in market-based solutions, not from an evangelical standpoint, but just that's how things work. The Corsia does not have enough tonnage without inclusion of Vera and gold standard as registries, full stop. You also then need that corresponding adjustment as a look through to Corsia. So when you go soup to nuts from sort of where we sit today, hopefully over the next 6 months, those are very, very, very attractive pricing. So, at an indicative price of 15.3, people can start to do the math and make an assumption around splits between us and our project partners from our AAF in terms of value of the 700,000 credits that are sitting, that are ours. Nothing else needs to happen for them to be ours or corresponding adjusted that sits on our balance sheet. And then number two, as we've put into our guidance and our AF, we should have just under 2 million tons within the next 6 months from that project, sitting on our balance sheet, subject to the splits that we've talked about in our disclosure documents. As I said at the top of the question, I've totally forgotten question, part two. So you'll have to refresh me, Jan.
No problem. Part two of that question is you how's the company planning on receiving these certifications for other projects?
Yeah, well, so our project part, this is carbon is a, in actuality and in sort of analog, like carbon requires a village. So we don't have at base a direct relationship with the Rwandan government. Del Agua, who's operated in country, for well in excess of a decade, has a direct relationship there. So for us, it's the starting point is working with best in class project partners. And it goes back to where I think we've been successful as a business is when we started, when we sat there, gosh, 2.5 years ago with a pile of cash and a pipeline of opportunities and saying, how do we best express our shareholders' capital, of which we're, big principals and big shareholders as well, written big checks, keep writing checks, all that kind of stuff. It goes back to basic business where it's like, well, who's done this before? Let's not finance the new guy. And generally people that have done it before have relationship with governments. I think as the world transitions, when you think about the range of countries that could give a CA, and you think about it relative to their commitments under Paris Agreement, there's largely I keep saying companies, and I really mean countries, sorry. There's countries that are short carbon, and there's countries that are long carbon. And you sort of think about, the highly industrialized world versus LDCs. And when you think about that mix of LDCs, those that have higher quality rule of law, have better government infrastructure, those are the ones that are likely going to be able to have the ability to really approach a CA thoughtfully. Rwanda is certainly one of those countries. We think rule of law is excellent in Rwanda. We think the government does a great job in policy as well as just in general for their people. I think it's really, really good. Vietnam is the same way. It's, the people here will say, well, oh my gosh, Vietnam's a communist country. And it totally is a communist country. That's not, I personally love living in America. I love democracy. But it's from a rule of law from us operating there, man, it's been a really, really great place to operate. We really help the people there. And we think that there's a very high probability and possibility from what we're seeing that there will be a corresponding adjustment in Vietnam because they're effectively long carbon, right? So it's a tool for them on a global, think about it almost as like global cap and trade to export, right? It's nobody really talks about it that way. I don't really want to start getting into like prognostication of how the actual economics of all of it work, but that's the pathway. And when you tie it all together to like, well, how do we make sure we get this going forward? It's again, it's through sound underwriting. It's understanding where we have real edge and where there'll be edge in the marketplace. To put it in context for the listenership out there, the folks that are on the call, the voluntary market was, sort of like $750 million to $1 billion last year. Compliance markets were about $1 trillion last year. And the implied cost of capital with the size and breadth, liquidity, compliance nature of compliance markets, government backed or government mandated nature, that's a much more financeable market. So having these voluntary markets continue to sort of slough off and become compliance markets is a really, really good thing. And it's a good thing for us. It's a good thing for carbon businesses. It's a good thing for the atmosphere. It's a good thing for a lot of stuff. So, people look at it and say, oh my gosh, that's how do we predict that? And we look at it and say, wow, there's a lot of opportunity and there's a really big lift in terms of value from A to B.
Thank you, Michael. The next question is, could you please provide an update on the STX partnership?
Yeah, for sure. So for the folks that don't know, STX is an environmental commodity house. They're a private business and they're the largest trader of the VCM. So they trade lots of environmental commodities. They're really, really smart. We really like working with them. And they've traded they were the number one from the data we've seen. They were the number one trader last year and in prior years as well of the voluntary carbon market. We announced late last year a partnership with STX whereby we are building and we're working on collaborating to build effectively off balance sheet pooled vehicles to allocate capital upstream carbon markets. Really, the value when you think about STX is they come with an incredible amount of sourcing on their own. They have a carbon development business in-house with flow of projects. Base has the same. Putting those together in certain ways or in very specific use cases within carbon is a really, really good thing. That's step one. Step two, we know how to underwrite, we know how to portfolio manage, we know how to manage deals. And I'm not saying we're portfolio managers here. It's just a skill set that we bring that happens to be really valuable in this upstream business. And then finally and importantly, STX has relationships with all of the carbon emitters from a corporate standpoint. I shouldn't say all, the vast majority or many of the carbon emitters in the marketplace. So they talk to something like 5,000 clients. There's I don't want to put words in their mouth, but there's a core group of those that they talk to on a regular basis that they trade with, that they're talking about their carbon policy. Where is that valuable? That's valuable because that is the offtake. That is where the market is. And having the understanding of where demand from corporates in the market is really, really valuable in a developing market as you allocate capital. So I talked about before the information flows within our business. That's, for us, we're always having those conversations. Understanding where the market is just as important to us to understanding all of the, 498 line items in each of the project models to make sure that we understand where the risk is and know we're mitigating those properly, either operationally or structurally within our documentation. So for us, the partnership with STX is a really valuable growth engine, both in terms of how carbon markets evolve, particularly around where the market demand is for carbon credits, but also within Base as a backdrop of our equity cost of capital, because we're not going out and selling. How do junior market businesses normally grow? They go sell a bunch of shares and then they use that money to grow their business. And that's great and that's wonderful. But when we actually have a real equity cost of capital, it's not just some, out of the money option out the curve on a, piece of dirt that has some mineralization or some hydrocarbons in it or whatever the case may be. For us, we generate free cash flow. We have a real opportunity cost within our business. And we have a real cost of capital that we can, not just model, but it's visceral. We can see it, feel it, touch it, smell it. We're not diluting anywhere close to here. And again, it's the opposite. We're buyers and we continue to be buyers. We have been, we'll continue to be. So the question for us is how do we grow our business and all of the opportunity that we see, but do it in a manner that is accretive to our shareholders. And so STX is a big step in that direction of being able to access larger pools of capital to allocate into a broad swath of project types with our expertise that Base and its shareholders will enjoy value and capital returns, further information flow, further diversification, but not doing it at the cost of diluting an enterprise, which we're not selling a share anywhere close to here.
Thank you, Michael. Next question is regarding the NCIB. How do you prioritize between share buybacks and investing in new or existing projects? What factors might lead you to shift focus from buybacks to a more aggressive investment?
Yeah, so I think that the motherhood and apple pie answer is, everybody on this call is a capital allocator. How do you decide between stock one and two? If let's just say you're just have a common equity business, make it really, really simple. It's what do I know? What don't I know? Where's their opportunity? What are the expected returns? So for us, we think very deeply about what our implied equity cost of capital is. And we think deeply, not just around, hey, I ran an Excel and the Excel tells me this. Excel's great. I love Excel, but Excel's a tool, right? That's all it is a tool. We think really, really deeply around the optionality that exists within our business, both financially and also in terms of growth. So for us, I actually did a bunch of numbers and math before this call of, hey, like here's our cash plus the value, pick a price on the Rwanda credits, plus, we've announced that we're expecting another about 6 million USD prior to year end, pursuant to our Vietnam project on our fixed price offtake with Citibank. And you can add all this up and you can get to a really, really big cash number. And that's in excess of the cash that we're sitting on now. So any purchase is literally a free option. Plus you have the accretion on the cash. We can do all of that math. But at the end of the day, really simply to me, one really, really high number. Okay, so as I said before, we're sitting on, as of the end of the quarter, we were sitting on $7.5 million of cash USD, not CAD, USD, as of the end of the quarter, and we've announced about just over $11 million of subsequent events of cash generation. That's just under 19 million US. As I said before, that's about $26 million Canadian. At 50 cents a share, we're trading south of that right now. But at 50 cents a share, to use $10 million Canadian. Okay. That's 20 million shares. So that's less than my current cash balance. And then that represents, whatever, 17% of my float outstanding. So with further cash generation, every CA on my balance sheet, every shareholder owns that pro rata more of the cash that remains. They own that percentage more. So on a pro rata basis, you're not diluting, 1x, you're diluting, 0.8x on your cash because you have that accretion. That's really, really valuable. And that all feels sort of like cigar butt investing. But we haven't talked about where the actual, multiples of money growth and value in the businesses. That's just how do I understand that I'm getting a good deal from everything I can smell, taste, and feel in about 30 seconds worth of time. That's an easy one. And so when you think about the optionality in the business is when it starts to become very, very interesting. And I want to pause for a second and talk about the optionality because optionality in the junior market, the muscle memory or the body language is, oh, hey, if gold goes to $5,000, this, 0.3 gram a ton with high strip ratio gold mine is going to be really valuable. Or, hey, when, these rare earths are actually valued by somebody, or once I raise $1 billion and then I do this and I wait time and I bear risk. No, that's not the optionality we're talking about. I'll give you one example. In Vietnam, as we've said before, we have a $5 call option on every piece of tonnage out of that project. Tonnage of the rest of the project right now currently stands in, 20 to 25 million tons. We have the exact number in our AF. I think it's like 24 and change. Let's just use 24. Make the math really easy. So 24 million over the course of about 8 years. It's about 3 million tons a year. I've said before, we are subject to we're short a call against that tonnage on a percentage. So even let's say in a double digit number, let's even say our margin was only in that instance. We know what the Corsia pricing is. Okay. Let's say there's a corresponding adjustment in Vietnam, which, as I've said before, we spend a lot of time thinking about and researching and talking about. We're very hopeful for a CA there. Let's say various CAs are included within Corsia. As I've said before, we don't have purview on that process. We don't have access to that process, but Corsia does not work, in our opinion, from a tonnage standpoint without inclusion of varying gold standard. And we've talked about what the pricing is. We've talked about, we gave you the ABEX pricing before, 25 and 3/4 for the DEES 24 contract, 15.3 for the DEES 25 contract. It's very, very clear in that instance of the world, which isn't some, hey, acorns grow to the moon and all these other things have to happen. Some very simple and necessary actions are required for that pricing scenario, but you're massively off to the races. Even if our margin's $5 credit at that point in time, just on that option as a for instance, on that call option, that's 15 million US dollars a year of free cash flow generation. That's $20 million Canadian of free cash flow generation. You can start to generate free cash flow yields on this business. We also enjoy a expansion rate, which I referenced before, but I didn't get into the details. We enjoy the right to expand our Vietnam project by 50% of the stoves. And the way we did that project was on a prepay of credits. Again, I'd encourage people to go to the financials in the AF or call us. We can walk you through all the gory detail of what we've got in our financials and how all the accounting and all the math works there. But really simply, you can look at the value of the value we've generated in Vietnam thus far without a CA, without Corsia. And if there were either of the two of those, and hopefully, touch wood with, I'd call it a high end base case, both of those, man, like you can start thinking about the expected returns there. So, we'll continue to do expansions like that. We really like the ability to expand our India project. Our plan has always been to get the trees planted. As I've said before, we're at about 84%, I think is our number that we just disclosed in terms of tree planting. Will be done by the end of the year, and we'll be generating credits next year in that project. It's a really, really high quality project. We have the contractual right to expand that. And then there's just relationship expansion beyond there, that we're having the early conversations with our project partners VNV on. So, there's a number of organic things that we don't have to even go do something new to expand our book. On the NCIB side, we expand all of that optionality accrues to our shareholders. The final thing I'd say on the NCIB is I'm not really sure how many shares I can actually buy under the NCIB. We know where a vast majority of our shares are held. It's very, very tightly held. And I've seen this not just within base, but across many situations within public markets now, whereby the price discovery in public market is as, crappy as I've ever seen it in my professional career. And I've spent my career focused on markets. I really do think that a business like ours is being priced at the market by people who are trading a stock, not owning a pro rata ownership in a business and looking through to any of the fundamentals of our business. Some of it's part and parcel of the recent changes in rates, which just made markets feel sort of wonky. Some of it is the nature of the junior market. Some of it is, as I've said before, we're a bit of an odd duck in a really positive way, but because we actually have a business that you can value versus most junior market businesses, which are promotional, and they're promotional because they need investors to buy that nth share of the business to be able to fund themselves, or else they're game over. So, yeah, that's that. Happy to go into that more, but that's what I
No,
have to say about that.
thank you. It was an excellent answer, Michael. The final question for today's webinar: how does Base Carbon differentiate itself from other players in the carbon credit market?
Yeah, the I think that there's a question first of if you need to differentiate yourself and who are you differentiating for. I think in terms of, so let's just break that down really quickly. In terms of other producers of carbon, there's enough for, it's, you're like, well, who am I competing for? You're competing for project developers. We love our project developers. There's a couple other ones that we're talking to right now that we really like. There's some new methodologies like biochar that we're dipping our toe in on. But we're doing it sort of thoughtfully and methodically, and we're going to measure thrice and cut once on those. So for us, I think that competing is just, some of the basics of business. Like, do it, if you say you're going to do something, do real work, be nice people. Like, none of that is stuff you'd expect to hear on an investor call. But frankly, like in a developing marketplace, in a marketplace where developers are used to sort of, talking to a whole different host of people, I think that just some of those real basic building blocks of business go really, really a long way. I know it sounds, sort of simple, but it's really, really true. Then you think about, well, who am I competing for? Am I competing for, how do I compete for buyers of our credits? Markets are going to commoditize. I think, when you think about something with an inclusion, with a CA that gets included in Corsia, excuse me, it's a dynamic I talked about before, that it's not just, hey, here are my credits and here's why they're really, really quality, and then you have to go improve those. You have a marketplace that's giving you sort of the entry wristband, if you will, into saying, hey, I got credits and they're fungible with all the other units here. I think in terms of relationships, though, downstream, I think that curating, we actively do this again. I think this is where the Abex network and smarter markets is really valuable, with potential off takers from industry direct to base, that we could do really cool stuff with, as they have various demands for types of credits. I think that again, for us, it's the value of what we've done in our business. And then finally, for public market investors, and how do we differentiate ourselves? I don't think that on one hand, I don't think we really need to, but I think where we are differentiated is, again, like really some of the simplicity and the basics. Like, we've done it, it's not, hey, here's what we're going to do, and we have a blind pool of cash, and here's all these expected returns. We allocated $20 million into Vietnam. We've repatriated 30 to our balance sheet. We've allocated $9 million into Rwanda. We have 700,000 credits on our balance sheet. And just to give a sense, by the way, at an indicative price of $10, we would net back, we'd net back nine. We'd have net back about five, between five and a half and 6 million US dollars just on that $700,000 alone, cash. At an indicative price of 10. I've given you the Corsia pricing. For us, we've said this in our disclosures. I'll say it again here. We're not here to take views on carbon pricing, but we do think that the duration is so short for a adjudication and potential inclusion into Corsia. And we think that the delta between where you would get bid right now on those and where the pricing would be, we're talking about, fancy pricing, 25 and 3/4 for a DEES 24 contract on the Abex exchange is pretty attractive pricing. So, and that's without the market really, in our opinion, starting to get going. And that's without the market tying back to some of the indicative price points that we've heard from various industry talking airlines on where their internal expectations are. So we think that that's really attractive. So for us, it's it's with shareholders. It's you have to look at what we've done and value what we've done, and then value that in the context of our ability to continue to do that within our business. But I don't think you're taking a lot of bets to get there, and I think that the margin of safety is so incredibly high relative to the situation. Again, not giving investment advice or guidance on that. That's just personal view. And then when you start to think about the multiples of money in a scenario with Corsia, with CAs, and what that means in our business, and if the worst thing that happens is we buy back another 10% of our shares, man, I think that accretion is really huge. And I say that not as management, but I say that as a large shareholder of the stock and somebody who's written big checks into this enterprise as well.
Thank you, Michael. And thank you, everyone, for attending the call and asking any questions. Again, if we did not get to your questions today, we will ensure to send it to management and come back with a response. Now, over to Neil for some closing comments.
Great, great. Thank you very much, Jan. And Michael, that was great, Michael. That was exactly, I think, what a lot of us were looking for was a very high level update and on what's going on. So, Michael, I just want to finish on one a couple just quick notes in terms of a summary. So I'm clear. You've got the 715,000 credits in hand that you're basically just sitting on because you may get a better price. We stick though to just the basic fundamentals. Kind of year end, you're going to get two more issuances, right? Another one from Vietnam, another one from Rwanda on or before year end.
Base case. Again, we don't control issuances. The registries control those, and the submission of the verification report by the arm's length VVB to the registry. So we don't control those, but that is our expectation. But we're within the next 6 months, we're expecting our final issuance under phase one. So we'll expect about another $6 million, as I've said before, of free cash flow generation in Vietnam, and another, whatever it is, 1.1 and change million credit generation in Rwanda to get us just under 2 million tons in Rwanda sitting in our account, plus another $6 million, and then we're into phase two. It's not like those deals end.
No. I know they're going for years. So, okay, and then India starts. You get your first issuance, which is I think a once a year issuance, sometime in the new year in 25. Is that correct?
We'll have our first issuance there. Issuances largely can be as quickly or as slow as you want them, and you being the project developer, the project proponent. But like anything else in the world, there's a fixed cost to it, and you have to send people in the field. There's a lot of counting. There's a lot of effective auditing that needs to happen. So not really sure if we're going to do once or twice a year on that one, but you wouldn't really want to do much more than twice a year on those projects.
Right. But it does start. Basically, my point is in 25, you'll have issuance from all three. All three projects will be
all producing. I can't make this comment for India yet, but the other two on time and on budget. India, we're 85% or 84% of the way planted on the trees. So, we expect to be on time and on budget. We'll be planted by the end of the year. And remember, on India, as I said before, I think we signed that deal August 26th. Date sticks out in my head for whatever reason, of last year. It's August 20th. We're not even a year into that transaction. We're 80% of the way planted. So, and with India, it gets really dry and the ground gets really hard. So there's a portion of the year that you can't plant either. You need to sort of be planting peri-monsoon.
So just like I'm using the back of my napkin math here, you kind of hit Q1-ish and a Q125 between credits, and let's just stick to $9-10 a credit. Let's not speculate on the. I know the blue sky potential is massive, but we just stick to $9-10, which is what you can get now, basically. You should pretty well have in cash and credits and the equivalent thereof of your market cap by kind of 25 the latest. Like, is that a fair comment? Like I did the math, and if your market cap is 50 mil, between the credits and the cash you'll have in the bank, you kind of should be at a minimum in that range. It doesn't include all the issuances for 25. Am I on the right track with that?
I'm not giving guidance on that, but I don't think that your math is remotely off. I don't want to give guidance, but again,
Yeah.
like
Again, I'm just going through your presentation.
Math is math. Math
okay.
is math. So yes, that all sort of foots.
Okay. So okay, I'm going to leave it at that. I'm very excited about the play again. I think I can't find stocks with these market caps that have this kind of cash, a very low burn rate, very, very obviously powerful management with decades of experience. You've underwritten great paper. We've seen some catastrophes in other plays that have not underwritten great paper. So congratulations, Michael, because I think you've done an incredible job to date. I'm really excited about where this company's going. As I mentioned, Investor Cube, we are definitely we're shareholders, all of us. I am actually interested in buying more stock as long as it stays at these levels. I buy it higher, but I'll guess kind of to a certain degree as much as I can in the 48 or under 50 range. It seems like a gift to me at this price. And on that happy note, again, thank you everybody for attending today, taking the time to talk to Michael and talk to us. We are recording, as we know, the webinar, and once it is up and posted, we will notify everybody as well. And again, any other questions, please let us know. If not, thank you very, very much for your time today, and thank you, Michael.
Thank you, Neil. Thank you for hosting. Thank you for everybody spending time, and hopefully we unflabbergasted some people. So